I think the last reading and the one before it in inflation, the one before it to a lesser extent, do suggest that we are getting back on a disinflationary path.
Fed Chair Jay Powell there on the progress he thinks where we are on the inflation story. Welcome to the show. Half an hour away from the opening bell, Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles. Let's get to your top stories, shall we? Investors eyeing rate cut prospects on the back of those comments coming out of Jay Powell, sending stocks higher, mostly across the region here, following Wall Street's record-breaking rally. Now, Bloomberg has learned that China is developing lethal attack drones for Russia, a sign that Beijing may be deepening its support despite warnings from the U.S. Plus, we look at the transformation of China's premier investment bank, CICC. That's as the Communist Party becomes a more dominant force. Welcome to the show. Just under 30 minutes away from the opening bell. It's looking like we have some tailwinds coming through across these markets. S&P 500, you might have seen the headline, closing above 5,500. So this bull market continues, although when you look at some of the perhaps usual suspects, NVIDIA, case in point, did not actually join the rally overnight. More on that in a moment. And certainly is there conversation now really to be had on the broadening out of the rally. We'll talk about a Tesla story in a moment. That takes us into the China Open today, where you are getting a winning streak somewhat taking place, although we are still range-bound at Hang Seng Index. Up 2 days straight, up 5 in the last 6 straight days. As far as data goes, we have the non-manufacturing PMI numbers coming out this hour. That's the private survey, of course, Caixin. Oil stocks coming online across the region. Oil contract in Shanghai, ditto. That's one group we're tracking very closely as we push into these 2-month highs on global oil prices. And, of course, we have a CGB sale today, 3-year CGBs on deck. And we'll see what demand looks like, of course, on the back of just all the drama and conversations around how yields can actually get on the Chinese mainland. Right. Let's bring in our chief North correspondent, Stephen Engle. Of course, he's here with us on set to just help us co-pilot, of course, the next 2 hours or so. Among the many things that we talked about, what's top of mind for you?
Well, obviously, I mean, the equities rally in the United States, defying the doomsayers, again, because there's a little bit of weakness showing up, obviously, in the job market. We're going to get a slew of data coming over the next couple of days ahead of the 4th of July holiday in the United States. And then those, employment numbers on Friday, I believe. And then, of course, here in China, the EV story is going to take a little bit of wings from the Tesla story. So, I mean, there's lots to look at today.
Yeah, and I think almost everyone, perhaps, that you ask in China in the EV space looks at Tesla as perhaps their main competitor, don't they?
I think Mike Dunn said exactly that in all his discussions. He was on at 7:30 Hong Kong time, so we'll probably replay some of that interview here on Bloomberg Television. But again, he said of all his discussions with all the Chinese EV makers, they say they're one competitor that they look at from the West. It's not necessarily Mercedes, it's not necessarily BMW or GM, it is Tesla.
The Michael Jordan of EVs, as they say, not the LeBron. Okay, takes us into the market action today. Big move in Tesla overnight. In fact, since the close, we've had a series of upgrades on price targets on Tesla. More on that in a moment, though. A fifth of 1% to the upside. MSCI Asia Pacific right now. So Singapore is coming online. The reason I bring that up is we are getting a lot more upside there, up about 1% over in Singapore. Down to the equity market story here. Topics index in and around these 34-year highs. As you can see, we're flat right now, but effectively at 2,800 levels last seen back in 1990. We talked about oil. We are seeing some upside, 0.25%, as you can see, 86, 87, and then you effectively go down in terms of price as you go further out the contract curve. Golden Dragon Index overnight did this. Within this, of course, we talked about EV. So EV, solar, and Lufax, actually. One stock we're tracking is Lufax Holdings on the back of that big move up overnight. As far as futures go, the contract in Singapore, the contract here in Hong Kong, and you're looking at CGBs, your 10 and your 30-year yields, still seeing some downside here. So a conversation on that, of course, a deeper one as we go into the trading session today. We're flat on dollar China. We're mostly weaker, though, on the U.S. dollar for 2 days now, and yields have been pushing lower following, of course, the retracement higher, if you will, over the last several about a week and a half or so. Okay, well, that takes us nicely and perfectly into the conversations around Fed interest rates, and of course Jay Powell, the Fed chair. You also had ECB President Christine Lagarde speaking in Portugal about their respective policy outlooks. Have a look.
We want to be more confident that inflation is moving sustainably down toward 2% before we start the process of reducing how tight our policy is, of loosening policy. Frankly, because the U.S. economy is strong and the labor market is strong, we have the ability to take our time and get this right, and that's what we're planning to do.
We still believe that it's likely to be a bumpy road until the end of 2024, but we still have target at the end, in the second half of 2025, on the basis of our projections, and the baseline is unequivocal on that front.
Nancy Davis is the founder and CIO of Quadratic Capital Management. She joins us right now. Good morning from the Asia Pacific, Nancy. As always, a pleasure to be speaking with you. We just heard there from Jay Powell. See him as if he's a rapper. Your takeaway there, and it has, I guess, in many ways, based on the information we have now, are we definitely going to get a rate cut this year?
You know, it's hard to say definitely. I think, if we think about where we started 2024 in the U.S., the Fed Fund futures market, and you can see that on your Bloomberg terminal, had 6 cuts priced into the market. So expectations are way down over the past 6 months. I do think the jobs data Friday, it's going to be another important variable. A lot of people are out this week as well because of the July 4th holiday in the U.S. on Thursday. So it's going to be very interesting to see whether the data does turn out weaker than expected, because right now the jobs data has been high and then it gets revised down later. So I think if we start to see weak job numbers, we will likely get a rate cut, and probably one before the U.S. election.
Well, Nancy, we just heard from Jay Powell, and he's a bit cautious. Is it prudent to kind of wait and see what these numbers show, because there has been some easing in the latest PCE on the inflation front, as well as the job numbers. And I agree with you completely. Friday is going to be a very key number coming out of the United States. So, this economy is doing extremely well. I'm not necessarily talking about the S&P 500, which we'll talk about soon, but the economy is still pretty strong. Wouldn't you agree?
Definitely, there's a lot of complacency that the inflation battle has been won. I think that's the big question. Even in Powell's comments, he's sort of cautioning people to say, look, we're going to wait and see. We think we're out of the woods. But, day-to-day inflation still feels really high in the U.S. The big component of the CPI is obviously shelter, which is actually measured by owner-occupied rent in the United States. But day-to-day inflation still seems pretty sticky to me.
Yeah, well, if we remove the inflation factor as a major risk, and certainly I'm not saying we should, it's certainly gone away, a few notches from from this time last year, Nancy. And I'm wondering whether or not I can attribute the drop in market volatility down to the fact that inflation has sort of taken a back seat right now. And do you think markets are too complacent, I guess, is the other part of that question?
Yeah, I think that's a great point, David, that, volatility in the United States, obviously we've had big stock market rallies around the world, but we've also had a tremendous fall in bond volatility this year. So across the board in the U.S., you've had vol fall about 30% year to date. And I think that's just a sign that everybody is sort of rose-colored glasses right now. Even bad data is cheered by the market because it means, hey, the Fed can come in and cut rates. So it's definitely feeling pretty euphoric, pretty optimistic, pretty FOMO right now. A lot of people, are chasing the rally. There's a lot of momentum money in the market, and I think there's a lot of leverage that's back.
Well, Nancy, how many more miles does this S&P 500 rally have? 5,500 for the first time ever. I think the NASDAQ 100 closing above 20,000 for the first time as well. We're hearing maybe 5,700 by the end of the year, some optimists, but at the same time, they're also saying out of the other side of their mouth, the markets have gotten a little ahead of themselves. How would you read it?
I think it's pretty greedy. Like if you look at the annual returns, year to date, whether it's a Japanese stock market or the US market, things are looking pretty crazy. And it's only early July. So I think if that was an annual number, people would be feeling really good. So I think it's reasonable to say, look, proceed with some caution. It's all about diversification. And I think whenever people are complacent about one outcome, like right now, I think inflation expectations are pretty low. They're pretty symmetric in the United States. Everybody sort of thinks inflation's going to turn back to around the 2% level. And you can see that on your Bloomberg terminal with the break-even market showing it's all right around 2%. And I think that's the buying opportunity actually for investors. When people get fearful, you should get greedy. And when people get greedy, you should be fearful.
Okay, so what are we not worried about that we should be?
Well, there's a lot of vol selling happening inside of systematic strategies. It's a very popular thing right now to be selling to institutional investors, these quantitative strategies. They trade on swap format, and they sell volatility across asset classes as a way for carry. And I think a lot of the CLO portfolios, so a lot of investors out of Asia will buy structured products that have CLOs inside of them, and then they go and sell US rate volatility on top of it to juice the yield. And so I think that the problem is that there's a lot of leverage out there in the system. Credit spreads are incredibly tight. So even though we've seen rising policy rates, credit, if you look at the 2-year investment grade index in the US, it's 22 basis points. That can only go to zero or probably won't even go to zero. So it's so tight. Everything is really priced for perfection, especially in the corporate sector.
Yeah, and pushing some of the sentiment or the outlooks for long-term yields higher would be the potential of a Republican sweep in November. How much do you factor that in?
I mean, definitely since the debate, I think there's been a little bit of uninversion of the yield curve. So it's not because the market is expecting more cuts on the front end. It's not lower yields. It's longer kind of that bear flattening. I think, the thing to point out about the U.S. yield curve is it's massively negative. If you look at the 2s, 10s SOFR rate in dollars, it's about negative 60 basis points, like negative 60. Whereas if you look at the U.S., I'm compared to Japan, for instance, the JGB curve or the yen 2s, 10 swap curve is actually opposite. It's positive 65 about. So it's really kind of a tale of, the currency and also expectations for where long-term yields are going to be. And it's very contained in the United States. The policy rate is still 5.25, the overnight rate. So this inverted yield curve, it's been more inverted now than it ever has in our lifetime.
Nancy, it's so good to have you on this morning here in Asia. Best to you there in Connecticut. Nancy Davis, founder and CIO of Quadratic Capital Management. And coming up on the show, the China show to be exact, shares in Tesla and other EV makers surge after the company reports better than expected delivery numbers. We'll break that down with the details coming right up. This is Bloomberg.
Just going into the opening bell here, Shanghai, Shenzhen, and the sun is out, I believe, still in Hong Kong, certainly on the way to the office. Beautiful picture there across the harbor. A50 futures down 0.25%. 15 minutes to the opening bell. This is the China Show. Welcome back. First, midpoints above 713, I believe, going back to November of last year. So we're coming off, well, a second straight one where we're on a weakening bias as far as the fix is concerned. So higher and higher, weakest fix going back to November of last year. By the way, that comes amidst what really is a day two of dollar weakness, so maybe just the juxtaposition there is fairly interesting. We'll talk more about that. Plus, of course, the yield story. We have a 3-year bond auction today coming out of China. In about an hour's time, we should be getting more details on what demand might look like for that. In the meantime, though, let's have a look and take a step back from markets, have a look at geopolitics here. So Bloomberg has learned that China is making and testing lethal attack drones for Russia. That's according to European officials who are familiar with what's going on. Min Lo, our China correspondent, has the details for us. She's here with us on set. Is this a sign, I guess, that China is moving closer effectively to Russia as far as relations go?
Yes, so according to European officials who spoke on condition of anonymity, Chinese companies are now developing and testing a version of a drone that is modeled after the Iranian Shahed drone. Now, those are known as kamikaze drones because they're not designed to survive the attack. They can loiter for hours in the air before locking on the target and striking. It's very cheap to produce but hard to defend against. And Russians has been using thousands of these since the war started. The concern is that China will be able to produce this at a much faster rate than Iran, and these European officials are also concerned that this would cross the line of providing lethal aid to China. Now, China, of course, have denied that they provide any weapons directly to either party of the war. They have really made veiled swipes at other countries that provide direct support to Ukraine. They also say that they have been carefully controlling those export of dual-use equipment to Russia. Now, U.S. backs those claims. It says that China doesn't sell direct weapons, but that it has been providing components, those ball bearings, dual-use equipment. So if this is true, this is a serious escalation. It's likely to trigger probably stronger response like sanctions perhaps on China even.
It is something that the U.S. ambassador to China, Nicholas Burns, has told me on multiple occasions, including last week, that this is their main concern right now, keeping track of that. Another story you're following is, I believe the Finnish president, is it, who is saying one phone call could end the war in Ukraine. Give us the context.
Yeah, so this is coming in the context of the closer relations between China and Russia, and there is, the Finnish president saying that that Putin is now so reliant on China that China has so much leverage that it can just end the war if it so chooses to. And this speaks to the frustration that European countries feel that Beijing is still helping Russia to circumvent those Western sanctions. It's buying Russian gas, selling Russian cars, and I mean, take a look at the table we've prepared. China's trade with Russia has really increased tremendously over the past couple of years, and the opposite is true for Europe. We can show that table. Europe's trade, its share of trade with Russia has more than halved over the last couple of years. Have a listen to what the president of Finland had said about China's role in supporting that war in Ukraine.
In the beginning of the war, I think China was sitting on the fence. It was sort of looking around, trying to understand what was happening and why Putin was doing it and what the ramifications are for itself. But as time has progressed, and we're now almost 2.5 years into the war, China has started to provide Russia with different types of aid, not direct military aid, but issues linked to energy, sometimes even dual-use goods. I argue that Russia is so dependent on China right now that one phone call from President Xi Jinping would solve this crisis. If he were to say, time to start negotiating peace, Russia would be forced to do that. They would have no other choice.
The Finland president is also saying that Europe should really shift to a wartime economy now to consolidate their orders for ammunition, and that the European Investment Bank should push its red line to start financing the military industry in Europe as well.
Speaking of military, President Xi arrived, I believe, in Kazakhstan for the SCO summit. Expectations there, what the agenda looked like?
Yes, so he is going to meet with President Putin again. Second meeting in 2 months after Putin arrived in Beijing for a visit in May as well. The two sides hailed their relations and pledged to increase cooperation on economics, military ties as well. And a big announcement we are expecting from this SCO summit is, according to China Daily, they're expecting that Belarus will officially join as a full member. Now, this brings the SCO membership to 10 10 members after Iran joined last year, and obviously in 2017, India and Pakistan joined as well. So President Xi likely to hail this growing membership as the growing relevance of SCO to the world, part of his campaign to really push towards this multipolar world order. We're expecting economics to be on the agenda because these Central Asian countries are very strong partners for China's Belt and Road Initiative.
That's right.
They're also going to talk about terrorism issues given recent developments in Pakistan and Russia as well. And of course, geopolitics, that war in Ukraine, given the recent discovery that China might be helping to develop these drones for Russia.
Well, China correspondent Min Min Lo, thanks so much. All right, well, we'll be getting more analysis on the Shanghai Cooperation Organization meeting with East China Normal University later in the show. We'll also get their thoughts on the upcoming U.S. elections as traders weigh a possible Trump win. Dave?
As they mull and weigh that, what looks winning in the early goings here is the Hang Seng Index. We are poised for a higher open, up for a third day. In the early minutes, as you can see on your screens, we're led by EVs. Yields are pushing ever so slightly to the downside, which has really been the case for the most part of the last, several months. Dollar China 730, the opening bell 7 minutes away. A full preview is just ahead. This is the China Show. Welcome back. You're watching the China Show, poised for a higher open, as you can see on your screens. EVs in play. Yet, of course, all the news coming out of Tesla overnight, and certainly you do have the headline, but then we'll unpack certainly the context and the nuance there. Flip the boards, please. Analyst action, Shenhua Energy. We're looking at energy specifically, of course, in the context of what we're seeing as far as oil and energy prices go, 2-month highs in that. Race to outperform out of Daiwa there. So they're attaching a 40 Hong Kong dollar price target on this specific stock. Others on your screens as well. Citi raising SEO Express to neutral, and Daiwa cutting the opposite, of course, is true there as far as Sany Heavy is concerned. Raised to hold 1590 A shares, of course, given the denomination in that price target. Right, so a couple of stocks to watch. So we talked about this, right? EVs, property. We had some contracted sales numbers, to be more specific, which came through out of Vanke and also Country Garden. We talked about energy on your screens, the big ones there on. And we're looking at EVs too. So Li Auto is top of the table as we speak. You obviously have the others one, XPeng. Geely Auto all seeing some good upside going into the opening bell. We're looking at some futures right now going into the open, just over 3 minutes away, and we are poised for a higher open here in Hong Kong. The opening bell just ahead. This is Bloomberg. Welcome back. You're watching the China Show. 40 seconds to the midweek session. Yep, it's hump day, it's Wednesday, and you know what? I just realized we're more than halfway or close to halfway through the week. I've yet to hear anyone tell us they're cautiously optimistic about something. I guess there's hope, right? There is hope for that. A shot for every time you get that comment coming through. Welcome back to the show. We're looking at the opening bell. Well, as far as Hong Kong markets go, so we're looking at a third day of gains if it happens today, 5 in the last 6. Extremely range-bound as far as both onshore and offshore go. More to the downside onshore, of course. We're looking at 0.4 of 1%. We'll talk more about the EV story in a moment. So it's EVs, energy, and also, okay, I'm missing one, power producers. Okay, no, that's energy. Property, there we go. Okay, so it's Wednesday. Okay, what are we doing here? Okay, Shanghai crude. Oh, thank you for the kind reminder, of course. So first column, the 3 tiles to the right, copper, iron ore, and Shanghai crude. We're looking at commodities closely as well today. So copper's been in a pickup 4 days, I believe. Iron ore is about a 1-month high. Shanghai crude's at about a 2-month high. So we're looking at some of the names related, of course, to those moves there. We have a 3-year bond auction today. Keep an eye on that in about an hour's time. And also we have in 15 minutes or so, we have the Caixin numbers coming out, non-manufacturing coming out as well. Okay, flip the boards, please. We're looking at Hong Kong. Hang Seng Index, 18,000 should be thereabouts, almost. Okay, 80 points to that level. Decent gains across some of the big names on your screens. We're looking at property, as we mentioned there as well. Dollar China 730. we had this, well, before I talk about the scoop, Hong Kong retail sales actually contracted for a third month in May. So so March, April, and then May. The scoop I was just talking about, which we'll get to in a moment, is out of HSBC, or on HSBC. So cost-cutting drive there, non-essential travel, don't do it, reining in banker travel as well, curbing hiring, more on that later on. Now, I think there is also some fundraising going through here. So I think Bosidong is one of the stocks we're tracking at the open here. So the chairman coming out and raising their cash call there at a price that is lower, of course. There we go, hence 15% drop. $4.31 a pop. We're trading at $4 right now. Other things we're tracking here, so solar, big move overnight. Lufax Holdings mirroring the big move that we saw in the U.S. I'm having a look at my screens. I can't see anything why, but just be completely straightforward with you guys. But if I do find out something, I'll let you guys know. If someone can give me a tip, of course, you know how to reach me. We're also looking at China Vanke, which is flat at the opening bell. I think we were down 17%, 31% year on year on contracting sales. Also, I think Country Garden was also out with theirs. We'll talk more about that in a moment. Big move overnight. Tesla. The biggest move, fittingly, and the chart shows you this, heavy volumes, the biggest move since April. The reason April 29 was important, that's the day, of course, that Elon Musk, suddenly his jet showed up, landed in Beijing. He walked away, of course, with a partnership with Baidu on self-driving. Now, on that very story, Steve, of course.
Yeah, for more on the Tesla delivery numbers that saw the market rejoice, 10% up overnight, let's bring in our transport reporter, Danny Lee. So they have the second consecutive quarter of declines year over year, but that was good. The market rejoiced. Break it down for us.
Yeah, I mean, the numbers, they were a beat ultimately, and given the downward momentum we had seen from analysts, from everyone watching closely these quarterly numbers, a beat of around 4,000, you think that's a small margin or small number, but still it was better than what everyone had expected, basically, and, 5% down on the quarter, year on year. Not too bad overall. And so when people look to the future, everyone's now looking towards robo-taxis on August 8th, what this means for this kind of growth story that Tesla is trying to play out here with robo-taxis, with AI. So this is what's been driving the stock higher as well, this momentum, this excitement. But, even if the deliveries are kind of falling year over year, there's a big growth story outside of that in the energy storage business. And so, deploying more energy storage in the first 6 months of this year than basically all of 2023. So, even if the car side is slipping, there are other growth areas and areas of growth potential.
Do we have any insight on margins, for example? Because that's also been a key area of concern across markets. We
don't have any visibility yet on margins, and that will come in a couple of weeks' time when earnings are delivered for the second quarter. But given where we are, what we even saw yesterday with Tesla China factory numbers, the production or the deliveries was down 24%. You have to then wonder, and this is what we're watching for, is there going to be another round of price cuts in the third quarter? And given where we are in the China market, given this fierce competition, we've just gone through a huge round of price cutting. Are we going to see more price cuts in the third quarter, typically one of the weaker periods?
And that's where BYD has its scale, benefits to, they can cut costs, cut prices against their competitors and gain market share. They're also unveiling more range extender versions to basically increase their market share lead. What can you tell us about BYD?
Yeah, I mean, not just to increase their share, but to increase their dominance, especially on the kind of hardcore tech side that really underpins these vehicles and what you can say is how good they are compared to their peers. And what we can see is a fascinating chart around what has happened at the start of the year. BYD has managed to outperform some of its Chinese peers, basically some of these peers falling by 45% up until now, and BYD is keeping its head above water. Yes, it might have launched this pretty tough price war, but it's got the firepower, it's got the technology, it's got the employees to try and edge out the rest, and particularly in a market which is consolidating.
Danny Lee, fantastic as always, our Asia Transport reporter. Let's have a look at some of the market reaction, some of the reaction from analysts, in fact, here on the Tesla story. I'm just looking at my phone because the first one coming up is out of Dan Ives, and he actually just tweeted out about an hour or two back his new price target for the stock, which is now 300. Yep, there we go. They just raised their price target to 300, and he said the EV demand story is starting to return to this disruptive tech stalwart ahead of, as Danny just pointed out, of course, the big day to watch. Next big day to watch is August 8th, Robo-Taxi Day. Flip the page. Citi had this to say. Their neutral 182 is their price target for the stock, fairly encouraging as far as relative to expectations. And the next one is Cantor Fitzgerald, of course. That's Andrea Shepard. Overweight, 230 pop is their price target for that. As far as guidance go, this is where they think numbers will be for the next, well, for the current fiscal year and the next one. 2.15 to be, I guess, generous there is where they now expect, given where guidance was just laid out. Okay. That's a Tesla story. Let's pivot now and have a look at the property stores. So China Vanke is actually trading up and running about 6 minutes from now. Stock price is about to come up bottom of your screens. The home sales, I guess it depends how you look at it, right? Year on year or month on month, shares are down. Developers are up 0.8%. Let's bring in our Asia Stocks reporter, Jeannie Yu, is here to help us break down the story. How are investors viewing these latest set of, these are contracted sales numbers for June?
Yes, I think so far we see investor exposure in general to this sector is still really low. And, you know, I think earlier this month, earlier last month, we saw some data coming out which was slightly better than expected in terms of like month-on-month thing. But today we're seeing, you know, Vanke growth is like stalling, and then we've seen another big slump for Country Garden. So those are the biggest developers in China, and they're not really doing well. So, you know, previously people were talking about, you know, between now and the third plenum, it's going to be like a trading window for those Chinese developers because, you know, there is some policy hopes, you know, at the upcoming policy meeting, and, you know, and then we got some slight improvement in the June sales data, which could be as incentive for those developers. But so far, we haven't seen that yet.
Yeah, the Country Garden numbers are terrible. In May, they were down 76% contracted sales, another 73% down in June. So what does that really mean or leave for investors? Because obviously, they need these contracted sales. They need this cash coming in to help pay back their debt obligations.
Yes, exactly.
Right? So
I think there were some estimates by Goldman and JP Morgan earlier that, you know, for Vanke, if they continue to see another like 30% year-on-year contract sales drop, it's going to be a big problem for them to repay their debt. And same thing for Country Garden. And then Country Garden shares are still suspended in Hong Kong. So I think investors in general, they're still have very, very low exposure to this thing. And for those long-term investors, they're still looking for, they still need those figures to turn positive. But still, like, it's really tough at the moment.
All right, Bloomberg Asia stocks reporter Jeannie Yu, thanks so much. All right, well, Bloomberg has learned that HSBC is slowing down hiring and asking investment bankers to rein in their travel expenses. The move comes as outgoing CEO Noel Quinn looks to curb costs at Europe's largest lender. Our deals reporter Manuel Baigorri joins us now from Kuala Lumpur. Manuel, I mean, we've seen cost cutting and job cuts at other banks in the Asia Pacific as deal flows have gone down. What's the big impetus here from HSBC to cut their costs and cut staff travel?
Stephen, it's another step in this broader exercise that we've seen across the industry, ongoing, by the way, for quite some time now, because as you well said, deal making has been pretty sluggish for the past 12, 18, I would say even 24 months already. Been pretty tough last couple of years, and particularly even more so here in Asia Pacific, where you know, compared to a particularly interesting rebound in the US and in Europe in terms of deal making, here in Asia Pacific we're still down in terms of volumes from a year earlier. So no surprise that banks like HSBC that rely along on fees coming from Asia Pacific are reining in on cost and trying to make sure that the house is in order and just be more efficient, right? As they also explained to us as we were reporting in the story, they are prioritizing servicing clients and making sure they have the right people at the right time. But I think broadly speaking, they are trying to be more cautious when it comes to cost, and they're trying to hire only those that are absolutely necessary, and also trying to be more efficient when it comes to things like travel, for instance, just to make the most out of it. So I think it's another step in a broader industry theme that we've seen for quite some time, and this is likely to continue across the board, as deal making continues to be fairly weak the remaining of the year.
And to your point, Manuel, and Steve mentioned it at the top, this is something that we have seen in other banks. Give us more color on how the industry is doing at this point.
David, I mean, there is a big question mark about whether or not we might see something more drastic. We've seen and we've reported tons of times about the layoffs, from Wall Street firms, also some of the European banks. They've all gone through that, layoff round here and there. There is more to come, still unknown, but definitely as deal making remains soft, and the prediction across the board is that the second half is more likely than not going to be flattish compared to where we're coming from in the first half. So unless any dramatic surprises, positive surprises in terms of deal making, there is a lot of uncertainty right across the globe, with elections still taking place in some major economies, including in the US, still coming in the horizon. Interest rates, there's so many uncertainties that I think until there is more visibility, more stability, more confidence, CEOs will still decide to take a pause until there is more clarity on those question marks. So with that backdrop, I think we are likely to see more cost-cutting exercises across banks, not just in Asia, but perhaps globally as well.
Manuel Baigori there in KL for us, our deals reporter. Coming on the program, and really the juxtaposition here, interesting one, of course. A look at CICC, that is the premier investment bank in China, and how bankers there are learning to live by the official government oath to, quote, sacrifice my all for the party and also the people. That's the subject of our big take today. More details in that story in the next hour of the China Show. Staying on banks here very quickly. Over in Singapore, the outperforming market in the region, down to what you're seeing across the big banks there. DBS up 2.6%. Similar gains yesterday. Now taking the index, flip the page at 3,400. We've now topped the recent peak, now back to the highest level, effectively going back to 2022. Plenty more ahead. This is Bloomberg. Right. The latest of a series of PMI numbers just coming out right now. We're talking about the private survey. This is non-manufacturing, so this is effectively services. 51.2. Number in context. Number doesn't mean anything in itself. Of course, we're missing forecast by quite a steep margin here of about more than 2 points. Forecast was for 53.4. This is the lowest number as well on an absolute basis going back to the start, or
since
if not
October.
Yeah, late last year.
Lowest number since October of last year, 50.4. So, yep. The smaller private enterprises not feeling so confident in the services sector.
Unsurprisingly so, really, given how low consumer confidence is, generally speaking, of course, across the country. Which takes us now into, I guess, the conversation around the Fed. China's kept rates, if not pushing rates even further. The question is, Steve, is the Fed going to do the same at some point?
Oh, that's right. I mean, Chicago Fed President Austan Goolsbee says policymakers should cut interest rates if U.S. inflation continues to fall back to the central bank's 2% target. Goolsbee was speaking to Bloomberg in Sintra, Portugal.
Look, there's a danger from waiting, and there's a danger from making wrong moves. The basic function of the central bank and what the Fed's got to decide is we move to a quite restrictive posture. We raise the rates a great deal in a short period of time, and we've been holding it there. We got to this rate when inflation was over 4%. and inflation's now down close to 2.5%. So if you sit with the rate somewhere while inflation goes down, you're tightening. And the reason that you would want to tighten is if you think you're not on path to 2%. If you're on path to 2%, you've got to take seriously that the U.S. central bank's got a dual mandate. So if employment starts falling apart or the economy begins to weaken, which you've seen some warning signs, you got to balance that off with how much progress you're making on the price front.
So how worried are you about the unemployment rate, but with the jobs slowing down? I mean,
it's still, the unemployment rate is still quite low, but it has been rising. And if you look at quit rates, if you look at the ratio of vacancies to the number of unemployed workers and various conventional measures of the job market, they're cooling, but they're at a level which is still pretty strong. That's kind of what we've been trying to fully sort out. Now, I think if you look at the second half of last year, in the U.S., we had 7 straight months of excellent inflation. We hit a bump in the road in January of this year, but now we've gotten a string of improved inflation readings. If we get more like what we have just seen, to me, that feels like the path to 2%.
And that was the Chicago Fed President Austan Goolsbee speaking with our colleague Francine Lacqua. Now, staying in the U.S., here's the latest on the presidential race. The sentencing for Donald Trump's New York hush money case has been delayed by 2 months to mark your calendars now September 18. Now, this is so judges can review the impacts of a landmark U.S. Supreme Court ruling about presidential immunity. The sentencing could come less than 7 weeks before the likely Republican nominee's rematch against President Biden. Now, Trump faces up to 4 years in prison for the criminal case. The Trump campaign has, it says it raised over $330 million in the second quarter. That's a fundraising haul that gives them effectively more cash on hand than President Biden, whose campaign raised $264 million. The incumbent is facing scrutiny from within the Democrat Party after his poor performance against Donald Trump. Now, Biden is blaming jet lag after trips to Europe for that, admitting that he did not have the best night and should have listened to his staff. He visited France in June, then returned to Italy days after for the G7 Leaders Summit. Now, Biden plans to meet with Democrat leaders in a bid to reassure supporters over his fitness and also his mental ability. Now, this coming through in the last few minutes or so, the Washington Post has reported that former President Barack Obama has privately voiced concerns about Biden's re-election path and offered Biden his advice. Plenty more ahead here on The China Show. This is Bloomberg. Welcome back to our viewers. So we're just in case you missed it, about 7 minutes back, the Caixin numbers came out. This is services. This is for June. Not just missing forecast, missed it by a mile. Right, so it missed effectively the lowest end by quite a wide margin as well. It's also worth noting that the sample size is smaller than the official numbers, and the number of economists that actually have forecasts for this specific metric is also on the narrower side. All that being said, it doesn't change from the fact that the trend of the number is to the downside. And as Steve was pointing out earlier, 51.2 is the lowest level. You have to go all the way back to late last year for these numbers. And just for context, I guess, Steve, what does this show you against the backdrop of the official data, of course, that came out a few days ago?
Well, the official one came out over the weekend, and that tends to represent, obviously, the big state-owned enterprises, larger manufacturers, and also the services company, which includes property, by the way, in the services sub-index. Manufacturing PMI, the official one, was contraction, 49.5, the second out of 15 months, I believe, or third out of 15 months.
Below 50.
12 out of the last 15 months, the official PMI manufacturing has been below 50. That tells you where manufacturing is, even though there's been lots of stimulus and support for manufacturing, especially SOEs. Non-manufacturing also below expectations, 50.5. So it is a trend of big companies and small companies. Yeah,
it is a weaker trend, and I think that underscores the fact that while the PBOC perhaps is pushing back against lower and lower yields, and certainly we have seen them push back, and to great effect, this melt up in yields we've seen, the broader the path of least resistance in yields, I think we're showing the CGB board in a moment here, is really to the downside. So in fact, from that point in time where we had that melt up as well, again, as you can see on your screens, I think second day now that we are seeing some downward pressure on CGB yields, Steve.
Look at the 10-year there at 2.235. I mean, really, the PBOC would be comfortable with 2.5 to 3.5 there.
Yeah, so that's the range.
That's the range. So again, there's going to likely be some steps, as we've been reporting from the PBOC.
In the next hour, we'll be having, of course, the 3-year CGB sale, and we'll see what demand looks like for that, and if the sort of special bond auctions are any indication, demand would be strong as well. EVs in focus. Tesla, of course, came out with their guidance and their monthly sales numbers. That's why your takeaway from this, Steve, as you look at
BYD consolidates its lead and its dominance in the China market. That's my takeaway from the locals.
Okay, look at other movers. We'll unpack more of these stories in the next hour of the China show. Lots more, suffice to say, on the way. Straight to breaking news right now out of Malaysia, where a court has rejected the plea of ex-Prime Minister Najib Razak, of course, for house arrest, as according to his lawyer, is speaking at a briefing, I believe, that is taking place still right now, Steve, in Kuala Lumpur. I'm wondering if you're seeing anything else here apart from the actual headline.
No, just the context here. He'd been seeking that house arrest. I believe earlier this year there had been a reduction. His sentence was cut in half to about 6 years, and he was making a petition to spend the rest of his term in jail, which began in 2022 under house arrest. Of course, he was imprisoned in 2022 on abuse of power and money laundering charges in relation to 1MDB, that troubled state fund, obviously.
There we go. Yeah, so that's the update from now. Court decision, of course, over in Malaysia. Just back to markets right now. We'll get you more details on this, of course, once we do have them. In a moment, though, just very, very quickly, Hang Seng Index just coming off highs of the day here, 0.4%. We're pulling out from this beautiful day. And, I don't know why we're pulling out. It's a beautiful day here in Hong Kong. Just coming off highs a little bit right now. When you take a look at, I think, where the gains are coming from across the region, and let's flip the page, please, if we can. So the Topics Index, which touched a 34-year high, or was trading at a 34-year high as of going into the open today, is seeing a bit of a pullback right now. Nikkei is up, though, 0.7%. What you don't see on your screens is actually what's taking place in Singapore. We're still trying to figure out why. But effectively, you're seeing the three banks, DBS, UOB, and peers there effectively at record highs, pushing the actual Straits Times Index back to the highest level here, going back to 2022. We're up a fourth day on a benchmark basis at 181.15. That's now the highest since about May 27, May 28. So about a 5-week high as far as Asian equities go. This is really coming against the backdrop of a U.S. equity market that is unrelenting as far as upside move is concerned here. 5,500, of course, was the close on the S&P 500. Overnight, as Steve was also pointing out as well, the NASDAQ 20,000, that's taking place against the backdrop, really, of falling volatility, perhaps a better outlook as it pertains, better visibility as far as earnings go. Let's see whether or not this should, and is expected to continue, notwithstanding all the risks out there. George Maris joins us right now, CIO and Global Head of Equities at Principal Asset Management. George, first, good morning, and thank you for coming on the show. A pleasure to have you. Global equities are where we're coming off a very good first half, and I'm wondering, as you look ahead to the rest of this year, do you think the bulk of the gains is behind us or is in front ahead of us?
Well, it's hard to imagine that we're going to have a continued success at that level of magnitude as we've had in the first half. The S&P 500 being up 15% in the first half is pretty dramatic. That said, I don't think the conditions are ripe for a fail in markets. We've got very buoyant earnings. I think the earnings will continue to grow and to broaden everywhere. I think that'll be significantly supportive. We still have the promise of AI, all the investment in there, and the promise of increased productivity there. And then lastly, we've got substantial fiscal support and liquidity across the world. The U.S. is leading that, but we're seeing, substantial support from monetary policy across Asia, across Europe, et cetera. So the conditions, despite a huge run and elevated multiples, continue to be constructive.
George, Steve Engle here. Then do you change your asset mix or your portfolio mix right now to kind of hedge against any kind of downside, or is it still kind of wait and see until what the Fed decides to do and to get those job numbers on Friday and to see whether inflation is still sticky or not?
I think the move right now is, rather than hedging against substantial downside, is actually to broaden out your exposure. Again, the market, while strong, has been very narrow. I think you're likely to see a rotation. We're starting to see signs of that in markets already, but a rotation into sectors that haven't performed well in the first half and, frankly, in the last year or so, and that includes cyclicals, smaller capitalization companies, more value companies. I think those are more likely to perform well. They're actually fairly attractive on a valuation perspective, and they ought to do well as economic strength broadens.
Yeah, George, can you talk us through those, the potential, well, the sectors that potentially catch that bid, as you point out, hopefully the broadening of what's been, as you also point out, extremely narrow rally. What does the earnings outlook, how is earnings visibility across some of the cyclical plays?
Interestingly, we saw for the last, certainly for the last year, we saw the Mag 7 in the U.S. primarily drive growth, and anything related to AI and semiconductors, etc., really drove a lot of growth in the markets and the bottom-up estimates. We're seeing a significant change in terms of where bottom-up estimates are for the remainder of this year. Broadening, the Mag 7 earnings, while still strong, do decelerate, while the rest of the sectors actually accelerate and match, if not surpass, the earnings growth expected for the second half. And that's all other sectors that are out there. And that persists into the first part of 2025. So I think you're likely to see, again, a broadening of that strength, moving outside the narrow winners. And I think that's, frankly, that rotation will be very healthy for markets, rather than just pinning it on a few stocks that win everything.
George, how do you factor in the politics and the amplified rhetoric coming on the campaign trail and, of course, coming off the heels of that debate last week?
So a couple of different senses. First off, I think coming into an election cycle in the U.S., you're unlikely to see the whether it's fiscal or monetary policy look restrictive in any way. I think you've got the fiscal policy, whether it's treasury driven or whether it's fiscally driven in terms of infrastructure spend, continue to accelerate as we get into the second half, making sure that there are no economic potholes. I also think that the rhetoric that's happening currently will continue to drive a pro-market outcome. There's just going to be a backdrop here. The bigger question is what happens going forward. Both parties in the U.S., and I think we're seeing it consistently across the world, whether it's, frankly, it's Mexico, France, the U.K., Germany, India, has become much more populist. We have to understand what that kind of a government means. It certainly does imply, strong demand-driven growth, but also a lot more structural inflation, potentially more fiscal profligacy and greater deficits everywhere.
George, conventional wisdom would say that if the Fed does begin to pivot, whether it's September, December, or the beginning part of the year, we could see the king dollar lose a little bit of its steam. And that obviously has impacts in this part of the world. But the dollar seems to be growing strong. What's your outlook?
I think the dollar continues to be preeminent. Firstly, I think the market's got it right in terms of pricing about 50 basis points of cuts this year. We heard from Chairman Powell today. He clearly is looking for an excuse to cut. I think he'll get it. I think he'll probably get a couple of shots at it this year. But we've already seen, other, whether it's the ECB and others have already cut ahead. And I think that, frankly, the dollar, it's not as if the Fed is way behind the curve from everyone else. I think the market gets that the Fed is likely to cut. U.S. growth still is preeminent, and I think that's what's driving dollar strength more than anything else. The U.S., unlike the other leading economies, has self-sufficient growth. Whereas if you think about the other leading economies like Japan, like China, like Germany, they tend to be more export-driven, and that's a function, that is going to create less confidence in sustainable earnings or economic power than you get in the States. So I think the U.S., even with rates being cut, the dollar continues to be preeminent.
Yeah, George, in fact, I'm glad you brought that up because that is also quite evident when you look at earnings expectations. I mean, the U.S. seems to be the only a clear player in town, which takes me to my next question is, what I've heard you say is diversify away from the winners, the narrow winners. What I haven't heard you say is there a case to diversify outside of the U.S.?
I do. I think there's a significant opportunity outside the U.S. Right now, there's been such a narrowness and such a handful of U.S.-driven stocks that it's created ample opportunity elsewhere. Right. So a lot of those trends that are going to drive earnings in the U.S. will drive earnings elsewhere. Again, we're going to see export-driven demand. It really benefits companies that are located outside the United States. There's still a lot of innovation happening outside the United States as well that isn't priced anywhere nearly as highly as it is inside the U.S. And so I think that there's very compelling opportunities. And if we're thinking about value and opportunities in secular growing areas like materials, which sounds odd to say, but I think that's where we are. Those companies are primarily ex-U.S. companies, and so again, tons of opportunity to broaden your aperture and look outside the Mag 7, both in the U.S. and across the world.
Yeah, George, no pun intended here. My producer tells me just to broaden out the conversation to obesity. You feel strongly about that?
I think obesity after AI is one of the most compelling trends out there. If you think about obesity, it is one of the biggest comorbidities out there. Being able to, frankly, really get all of the issues that are caused by obesity, whether it's cardiovascular or diabetes and things like that, under control is a substantial boon to everybody's health. And I think it will significantly improve longevity. It will also radically change healthcare, right? If we've got, if we're reducing one of the biggest comorbidities out there, it's going to revolutionize how we're paying for health care, how we get treated, what's out there. So I think this is a dramatic global theme that will continue to evolve in ways that will be significant.
George, my last question here is a lot to unpack in a single answer, but what is your overall take on China, which up until recently has, excuse the pun, has had an oversized contribution to global growth? Not so much right now.
So interestingly, I think if you're to think about China, the market's been in a bear market now for 3 consecutive years, and now we're going on and a bit longer. We're in a technical correction and all sorts of other issues. The expectations for Chinese markets and the economic growth are exceptionally low. The bearishness is everywhere. There's clearly opportunity for better policy, more sustainable growth to occur. We've got the plenum occurring. I think the expectations going into the plenum are appropriately set low. If we do see any self-sustaining improvement in both the consumer sector as well as the property sector, things can really improve dramatically. We're not seeing it. I do think there's a willingness to address these reforms, maybe not at the pace the market wants. From a long-term perspective, you still have great companies that are located there, very technologically advanced, industrially advanced. They are globally competitive. The onshoring and nearshoring that you're seeing in the U.S., well, it also means that China is going to be onshoring and nearshoring, creating significant opportunity for companies within China to do well from its domestic, a kindling of domestic demand. So there's real opportunity. I just don't think you're going to get a flash in the pan or a flash boom in Chinese markets. But I think if you're willing to look out a little bit longer, we do see structural reforms. It could be a tremendous market.
Yeah, no big bang expected out of that third plenum, which is coming up in less than 2 weeks' time, but we will be watching it closely between July 15th and 18th. George, thanks so much for coming on to the China Show here on Bloomberg Television. George Maris, CIO and Global Head of Equities at Principal Asset Management. Well, coming up on the China Show, we look at why the PBOC's potential bond sales could signal more good than harm for banks. That's next. This, of course, is Bloomberg.
I do think this is an even stronger, more powerful message from PBOC. We think that the main concern here is financial risk. That's a lesson learned from the SVB incident back in 2023 in the U.S.
Yeah, that was Jenny Zhang out of Allianz Global Investors. I think she joined us about almost 2 hours back here in shows talking about really the pushback out of officials against this really unrelenting bond rally. In fact, just on that very note, so you did get a pullback in yields, although today we are seeing some slight downside still, second day in a row, as you can see on your screen. So it's green across this specific asset class. You're also looking at a bond auction today, I think 3-year bonds. More details on that, of course, in this or next hour. 2027 bonds. Thank you so much. $93 billion hitting the market today, if not already. Now, analysts say that this plan to borrow bonds won't stop the rally as the fundamental forces driving demand remain firmly intact. Let's bring in our chief FX and rate strategist, Stephen Chu, is here with us to talk us through the path for rates short-term and longer-term.
Right. So last time when we were here, we talked about the PBOC will warn the market, and now they say that they're going to sell bonds. They haven't done it yet, but they're going to do it if bonds continue to rally. If yields just sort of creep back lower to the record low for the 10s, certainly they will start selling bonds. Now, for the trend for the second half of the year, we do expect some further rebound. Actually, once the PBOC starts selling, yields may creep up a little bit higher. We look at the range of 2.5 to 3%. It matters because Chinese media actually talk about that range for the 10s. That's the reasonable range. Whether it could get to 2.5, it's going to be very hard. As you can see, there's a lack of quality long-term assets in China. Everybody just go in and buy. Higher yields, even better, especially for the wealth management products in China. They just go for CGBs. So that's why it could creep a little bit higher, but not that high. And then we can see yields dropping again.
Yeah, I mean, you alluded to it, and also in your piece today about the impact on banks of these bond sales. I think the state banks have, $4 trillion worth of wealth management products, and 90% of those are invested in fixed income. So this could improve bottom line at banks.
Yes, so basically this is a thesis of our banking analyst, Francis Chen, so I'm just going to quote him. As you said, $4 trillion of WMPs, so it would be better, obviously, from a yield perspective, because higher yield CGBs, but still it's not that high. So at the end of the day, it could help, but just marginally speaking. It could also help the trading and investment income for the banks, especially the big six, just because they usually just buy CGBs and they hold it, just keep it there and move. So for the CGB market, the 6 banks actually account for over 40%. So 40% of the outstanding CGBs just sits there doing nothing. So what the PBOC is going to do, they've said they're going to do, is to basically activate the market. So there's going to be more turnover, more trading income, and more investment income, because the banks can now finally realize the gains of the CGBs. So that's why it would be good for the banks. And Francis actually expect $23 billion of income this year for them.
And I mean, the other risk here is almost to financial stability. Is the pushback because they are sitting on such a huge amount of CGBs that if and when the economy turns, if inflation comes up, you know, you mark to market what's on your book. That's not a good thing if you suddenly see a massive melt up in CGB yields.
Yes, that's part of the reason. The key reason, of course, fundamentally speaking, is the PBOC always wants an upward sloping yield curve, because obviously they don't want investors to price in recession, deflation in the longer end. Yeah. And it's always healthier to have an upward sloping yield curve, not just in China, but across the world, even in the US. So that's why they don't want longer term yields to be that low. So that's why the clear objective here is to sell off the longer end to have an upward sloping, at least from the 10-year tenor onwards.
All right, Stephen, thanks so much for your time here on The China Show. That's our Chief Asia FX and rate strategist, Stephen Chu. Plenty more ahead as David and I wrap up The China Show, the second hour of which we'll be right back.
I'm very excited. Moderate pullback across U.S. futures following, of course, what was generally a good day, of course, on Wall Street on, what day is it, on Tuesday, as we go into the Wednesday session later on. Of course, it's jobs week, so keep an eye on that. We have some jobs numbers coming through, or jobs data to be more specific there on JOLTS, and, of course, commentary coming through out of Jay Powell, Austan Goolsbee on where they think the Fed rates will be, perhaps, moving forward. Now, Roubini Macro Associate CEO Nouriel Roubini says that the U.S. is headed, in his opinion, of course, for a soft landing. Speaking with us exclusively, he also says that the Fed is correct to wait before cutting interest rates.
I would say they overall are doing it right. On one side, they're still worried that the surge in inflation occurred in the first quarter may be slightly more than temporary, even if the latest number suggests a softening of core PCE. But now there's also something of a slowdown of the economy, something of a softening of the labor market. There is job creation, but the unemployment rate has ticked up towards 4%. So there is better balance and there is a slowdown in the economy. So based on their dual mandate, they have to worry about the inflation, they have to worry about growth as well. So I think they're right in waiting until they start cutting rates.
Nouriel, do you think that the risk should be more on the inflation side or the growth side, in that the risk is higher inflation or lower growth? Which camp would you be on?
Well, until recently, I would have argued that the biggest risk was upside on the inflation side, but now economic growth has slightly moderated, consumption is slowing down, there is some slackening in the labor market. So I think that the Fed wants to achieve a soft landing, but not a softish landing. They don't want to go to 2% with even a short and shallow recession, and therefore they have to start thinking also about the downside risk to economic growth.
Are we out of the woods yet in terms of we can avoid a recession, at most we'll get a soft landing?
Yes, with one caveat. You know, a year ago, everybody worried about a real hard landing. Then there was a risk of a softish landing. Then people said, no, we're going to achieve a soft landing. But recently, there was both a growth above potential and inflation above target. So the risk was that actually the economy was growing too fast and will be in a no landing situation. And no landing will lead the Fed to stay high for longer or even higher for longer. That was the risk. While I would say that right now the softening on the growth and labor market side suggests that maybe the risk of a no landing is reduced and we're going towards maybe something closer to the goal of the Fed, that is a soft landing.
That's Nouriel Roubini, Macro Associate CEO, speaking exclusively with Bloomberg's Alex Steele and Scarlett Fu. And here are some of the other corporate stories we are following this morning. Independent film and TV producer Skydance Media is said to have reached a preliminary agreement to buy Sherry Redstone's National Amusements and merge with Paramount Global. Sources say an agreement could be announced within days, though the deal could still fall apart. The Wall Street Journal says Skydance is offering to pay $1.75 billion. Bloomberg has learned that Apple is getting an observer role on OpenAI's board. Sources say Apple's App Store head and former marketing chief Phil Schiller has been chosen for the position. They say the arrangement will take effect later this year. Apple earlier announced it would offer ChatGPT in the iPhone, iPad, and Mac as part of its suite of AI features. Bloomberg has learned Anglo American, by the way, is weighing options to push ahead with the sale of its coal business after an explosion at its flagship Australian mine. Sources say this may include selling individual assets or excluding the damaged operation in a possible deal. The plan to exit coal was part of a dramatic restructuring announced earlier this year as Anglo fended off a takeover pursuit from BHP. And Eli Lilly has won U.S. regulatory approval for its Alzheimer's treatment, which has faced a number of regulatory delays. The drug, called Kisunla, will compete with Eisai's Alzheimer's treatment, which has been available in the U.S. since early 2023. Lilly saying the drug will cost $32,000 in the first year of treatment. Both drugs remove certain toxins from the brain and are only approved for early-stage Alzheimer's. Dave?
Yeah, we're looking at the currency markets now. So one of the headlines you might have seen in the last, 15 minutes or so is the Japanese yen has now dropped to a 33-year low against the Aussie dollar. Certainly this recent hawkish tilt out of Australia and some good numbers which came through about an hour back on building approvals, pushing the pair to about 107.90, which is really a level that we haven't seen in, do the math, 2024 minus 33. There we go. That's a currency market story for now. Singapore and some of the banks there in play. Flip the boards, please. And that specific index has now hit the high since 2022 as share prices of the banks, DBS, OCBC, and UOB, have now hit, in some cases, I believe, record highs on this. This market is your standout across the Asia-Pacific today, 1.4%. So that's a market story for now. Plenty more ahead, plus a wrap of the morning session in Tokyo. There we go. This is Bloomberg. Okay, is it me or is it dusty or foggy in Tokyo? I probably just haven't had good sleep, if I'm being honest, and my eyesight is probably a fraction of what it should be. Thank you so much for pulling out even further. 0.9% to the upside of the Nikkei 225 as we go into the lunch break there. 34-year high, if you've missed it, of course, since Friday, we've been hitting highs and highs on the Topics Index. We crossed that threshold back on Friday. We've topped a recent high. And at 28.62, certainly one of the best performing, if not the best major market this year. Up 20% year to date on the Topics Index. Dollar yen 161.60, and of course there we go on your 10-year Japanese yield. Okay, the rest of the region though, in terms of sectors, if you're curious what's driving these markets, the cyclicals are doing well. You do have a push, of course, across some of the energy plays given the move up in oil prices. Some of the consumer plays within that, of course, consumer could be things like tech and software. In many cases so far this year, what's really done well is things like hardware and chips. So IT, 0.8% to the upside. We're softer, generally speaking, on currency markets today, so the dollar's a little bit higher, although the trend from, if you draw the line from Monday, has been certainly slightly weaker and slightly lower in the Bloomberg dollar index. So that's the market story. It's very quiet, if I can be completely honest, too. So before I say anything speculative, let's turn it over to Steve now.
All right, Dave. Yeah. Well, turning away from the markets right now, here are some of the big geopolitical stories we're following in the region. Chinese Coast Guard has reportedly detained a Taiwanese fishing boat and its 6 crew members. Taiwanese officials saying that the vessel was stopped near the island of Jinmen, a few kilometers away from the mainland, and taken to the Chinese port of Weitou. The detention comes as China looks to ramp up pressure on Taiwanese President Lai Ching-te. Beijing sees him as pushing for independence for the island. Well, the Philippines says it's making substantial progress with China in managing their dispute in the South China Sea. Officials from the Philippines Foreign Affairs Department and China's Foreign Ministry met on Tuesday, Manila saying while significant differences remain, both sides recognize the need to restore trust. Last month, a clash in the waterway led to a Filipino sailor losing a finger. European officials, meanwhile, telling Bloomberg that Chinese and Russian companies are developing a lethal attack drone. They say the firms held talks in 2023 about collaborating to replicate Iran's Shahed drone. A version was reportedly developed and tested this year in preparation for shipment to Russia. Now, in a statement, China says it does not provide weapons to parties of the Ukraine conflict.
Let's stay on this story that Steve just gave us an update on. So Finnish President Alexander Stubb says Russia is so dependent on China that President Xi Jinping could possibly end the war in Ukraine with just a single phone call. He spoke exclusively to Bloomberg from Helsinki.
In the beginning of the war, I think China was sitting on the fence. It was sort of looking around, trying to understand what was happening and why Putin was doing it and what the ramifications are for itself. But as time has progressed, and we're now almost 2.5 years into the war, China has started to provide Russia with different types of aid, not direct military aid, but issues linked to energy, sometimes even dual-use goods. I argue that Russia is so dependent on China right now that one phone call from President Xi Jinping would solve this crisis. If he were to say, time to start negotiating peace, Russia would be forced to do that. They would have no other choice.
How likely do you think that that phone call would be made?
I don't know, but I call upon China to do that. If China is genuinely interested in peace, if China is genuinely interested in harmonious relations between nation states, it cannot allow a country like Russia to drive an imperial, at the end of the day, aggressive and colonial war against a independent nation state. It needs to protect the international rules which are linked to territorial integrity and sovereignty. That is the right thing to do, and that would also show leadership from China. And I think it would get a lot of goodwill, not only from the global south, but also from most countries in the global west, were it to be taking a stronger role in ending this war.
That's the Finnish President Alexander Stubb speaking exclusively to Bloomberg News in Helsinki. Well, Xi Jinping and Vladimir Putin have arrived in Kazakhstan, where they're holding a meeting on the sidelines of the Shanghai Cooperation Summit, or SCO as it is known. Let's now bring in Joseph Mahoney, professor of politics and international relations at East China Normal University. He joins us from Shanghai. Joseph, thank you so much for joining us. What do you think the significance this year of the SCO, and what kind of outcome would you expect at a time, of course, after Vladimir Putin has consolidated his support from North Korea? He's also had a recent meeting with Xi Jinping. What do you think is going to be the top takeaway from this SCO?
Well, talking to my contacts in the SCO, including some very high-level officials, I think the topics that they're discussing are a little bit more mundane and future-oriented. I think they realize that they've had several years of success, that they're still growing. I think they're still interested in trying to move forward with humanitarian and cultural and economic programs. I think there's some concern that they lack a financial structure or institution to support some of their grander ideas. Of course, we see some states like Iran and Russia trying to promote de-dollarization. There's some debates over what should be the official language, with Russia and China reportedly not that interested in English being the official language, but the other states remaining committed to it. So a lot of it's rather mundane. I don't think we're going to see any major breakthroughs, but I think we do have to understand that the SCO does provide or play a very significant role in promoting positive relations in this region.
Yeah, and to your point, Joseph, David here, by the way, perhaps the most globally relevant pair here would be, to Steve's earlier point, Russia and China. How would you best describe the current relationship between the two at this point?
Well, I think, given your lead-in with President Stubb of Finland, I think there's this misunderstanding in Europe that China is somehow the shot caller when it comes to Russia and even the conflict in Ukraine. Certainly, they have a lot of strategic alignment. The thing that I would point out to my European colleagues is that China recently signed a strategic partnership with Bahrain, which is home to the U.S. Fifth Fleet. It has a strategic partnership with Australia. It has a lot of them with many different countries. But that strategic partnership really began to accelerate, by the way, through the auspices of the Shanghai Cooperation Organization, following the U.S. penetration of Central Asia with the invasion of Afghanistan, which, as we recall, the United States built air bases in former Soviet republics, which created a lot of unease in both Beijing and Moscow. And it continues, this strategic partnership continues today, given the significant threat posed by U.S. submarines against China in the South China Sea, and certainly the U.S. Missile boats under the ice, which China needs Russian support to help mitigate those threats. So, the point is that, and there's the other issue, which is, back with the first Gulf War, there's some strategic analysis that indicates that the United States was putting that huge footprint in the Middle East in order to be able to lock up global oil supplies with China in mind as a strategic objective towards China. And this is what forced China to diversify its energy sourcing in Africa and certainly Russia. So we have this strategic partnership that exists between Russia and China, but it's one that has largely been a reaction to the threats that both countries face or vulnerabilities they face vis-a-vis the United States.
Joseph, this is not intended to be a loaded question, but how much reputational damage in Europe, obviously in the United States perhaps, has China taken for aligning itself with Moscow as the war enters its third year? You're in the Shanghai studio a week ago. I was in the exact same position there speaking to the U.S. ambassador to China, Nicholas Burns, who essentially said that China had misjudged the impact of the war on the relations that Europe has with China. Would you agree with that? And what kind of reputational damage does China suffer from this?
Well, I would not find myself in general agreement with Ambassador Burns, but what I would say is that China has long been aware that taking a neutral position, that it is not aligned with Russia over the conflict in Ukraine, but taking a neutral position would be very costly in terms of its relationships with Europe, and it indeed has been costly. I was in Ukraine last summer doing field work, and by the way, everyone I spoke with in Ukraine, including Azov representatives near the front, everyone there seemed to understand that this was not an unprovoked war of aggression, that this was a proxy war between the United States and Russia fighting over control of oil markets and how energy is paid for. And that all three countries bore a significant responsibility for the conflict that was happening there. And by three countries, I mean Russia, Ukraine, and the United States. That's the common understanding in Ukraine, but that's not the understanding that we hear from people like President Stubb, who continue with this narrative that Russia is an imperial power, that they are attacking Europe, and that China is somehow responsible or should be responsible for that. So I dismiss this idea, but I think China is very much concerned with the fact that they have paid a substantial price in terms of their relationship with Europe. And I think they've always been aware that whatever benefits they got in terms of their relationship with Russia, it would by no means compensate for the losses. And I do think that, early in the war, China was very much interested in trying to promote peace because they saw this problem coming. But I think they also understood that neither Washington nor Moscow were ready to move forward. And so China has bided its time.
Right. Joseph, you brought up the U.S. there, so we can pivot to the U.S. right now. And I'm curious what the mood on the ground is and around, well, a couple of topics, and if you could give your opinion on both. The disastrous debate, of course, Joe Biden late last week, that's number one. And number two is if it is Trump 2.0, and Donald Trump has repeatedly said that U.S. allies have to do more of the heavy lifting abroad, including, to your point, on the military. Does that counterintuitively mean as tensions come down and the U.S. steps back from many of these fronts?
I don't know. I think that we've seen a number of people who are, perhaps connected with the Trump camp in one form or another, saying a lot of provocative things. And it's really difficult to know what he's going to do or what he's thinking, or indeed if he's even going to win. There is obviously increased concern after the debate. I think the position in China remains that both Trump and Biden present risks for China. And I think the consensus remains that Trump is still a wild card. And Beijing dislikes wild cards. They dislike instability. But they do think that Trump could harm China, but also the U.S. interest in terms of Biden being a very careful bloc builder, a strategic builder. It could be that Trump could wreck a lot of those relationships. But, I think this is playing out in various ways. I think a lot of countries right now are hedging. No one really knows what's going to come in the next 6 months to a year. And certainly I think it's having some impact on some of the thinking that we might see coming out of the third plenum, in so much as China is trying to consider how deep it needs to go in terms of addressing some of its structural reforms.
You mentioned the Finnish president there. Obviously, he has his concerns, too, because they have that lengthy border with Russia. And that kind of pivots to the next question about what David just asked about Donald Trump. There's speculation he could potentially, as David also alluded to, undermine the authority of NATO, which could potentially cool things, but it could also potentially undermine NATO at this time. How do you see this?
Well, again, it's really sort of a remarkable change. We saw the incredible pressure that Trump was bringing against NATO, and certainly unnerving Europe. We know that Trump was a steadfast supporter of Brexit, and that Brexit has been extremely destructive in the UK. At least that's what we see from the opinion polls now in the UK, that this was really a disastrous path to take. And I think there's this understanding in Europe that the U.S. has by various turns either undermined European security and well-being, and therefore created a security trap that required more dependence on organizations like NATO. Conversely, we have someone like Trump who might come back and take it in a different direction. But again, no one really knows. I think it's sort of remarkable that the whole world at this moment is kind of fixated on what American voters are going to do. And indeed, American voters in 5 or 6 states are going to have such a tremendous impact on what we see coming in the next year or so.
Joseph, a pleasure to speak with you always. Joseph Gregory Mahoney, there, Professor of Politics and International Relations at the East China Normal University, joining us there out of our Shanghai studios in Lujiazui. All right, just ahead here on the show, how the Communist Party's dominance is transforming the country's premier investment bank, CICC. Our big take is next. This is Bloomberg.
And welcome back to the China Show. Sources say a growing number of top bankers at China's premier investment bank, China International Capital Corp, or CICC, are pledging their loyalty to the Chinese Communist Party. That's the focus of today's Big Take. And let's bring in our Asia Investment Bank senior reporter, Kathy Chan, joining us from the early hours of the morning in London. Kathy, thanks so much. Big cultural changes obviously happening within the firm. When did it happen, and what really triggered it, and who's leading it?
Yeah, what happened is President Xi Jinping's ideological shift has just really gained momentum last year. So the new appointment of the former chairman of Galaxy Securities really marked a notable shift in terms of the firm's direction. There are more ceremonial practices, such as reciting Mr. Xi's slogans and ethos before meetings, staff displaying the 5-star flags in Chinese clients' office to symbolize unity and alignment with the party. So there are a whole sort of cultural changes within the firm, and it seems last year it particularly become more evident, and there are more members of the firm are willing to sign up as a CCP members, because that would be seen as a potential good pathway in your career.
And Kathy, how has that changed or showed up in the day-to-day operations of the bank?
Yeah, basically the staff the culture itself have shifted from being very aggressive, still chasing sort of mode, to more like largely complacent, partly because the pay of the firm is no longer a motivation there because of the changes there. There has been a pretty distortive compensation model being created. Staff are basically told they are working for the party, not for themselves, not to enrich themselves. So bonuses are slashed, morale is really low. That's one thing. And also in terms of the focus, the bankers are doing more stuff in second-tier cities because there are no more big transactions. So the overseas competitiveness of the firm in general has diminished. And also with this Chinese ideological infusion, I think the global firms or investor clients are probably increasingly skeptical about doing deals with CICC because especially the current climate, they probably would prefer to work with the Western investment banks.
Well, Kathy, it's an interesting development because, as you know, I've been covering China for many, many years. I remember when this joint venture, essentially, CICC was formed with Morgan Stanley. Yeah. In fact, that tower there, Guomao in central Beijing, or in Chaoyang district of Beijing, is known as Morgan Stanley Guomao, right? CICC used to be known as that. But it's a very different business model now with a heavy, influence by the Chinese Communist Party, which is promoting common prosperity. It seems like it's an abrupt turn from the Wall Street roots. And how does that impact its mandate?
Yeah, the common prosperity drive is really the key thing here. Although the deal-making environment in China is not good, I think that morale will continue to be low. A lot of bankers, sources we had there, basically already looking for jobs elsewhere. The original spirit and essence of CICC when it was created with Morgan Stanley is subsiding, is fading. So the company, as it was originally conceived, founded by foreign educated professionals, will cease to exist in its true form in later years. And, Western investment banking is not the flavor for China, and the limitations on pay, undue emphasis of communist ethos, and the environment is not conducive for bankers with international experiences and businesses.
Kathy, thank you so much. Fantastic piece. Kathy Chan, our Asia Investment Bank senior reporter, joining us from the early hours, of course, there in our London office. You can get more on the story on the terminal on Bloomberg.com and also on the Big Take Asia podcast. Listen to it, iHeartRadio, Apple Podcasts, and also Spotify. New episodes drop every Wednesday. Plenty more ahead. This is Bloomberg. Over 100 people were killed following the stampede at an overcrowded religious event in the northern Indian state of Uttar Pradesh, one of the deadliest such incidents in decades. Let's bring in our South Asia economy editor, Ruchi Bhatia, to get us up to speed on the story. What happened? What do we know, Ruchi, about what happened and what's being done at the moment? What's happening on the ground?
Well, a horrific stampede took place at a religious event in the Hathras district of India's most populous state, that is Uttar Pradesh. This, of course, has claimed as many as 100 lives. What we do know so far that the administration says that many more people were present at this event, and that is the reason that we've seen such a horrific incident really taking place. The opposition, of course, training guns at the government. Today we do know that UP's Chief Minister Yogi Adityanath will be visiting the site to really take stock of what really happened yesterday. What is, of course, quite sad is the fact that despite, and religious gatherings, remember, are not very rare in India, and especially stampede-related incidents are, they keep happening every few years. In fact, a recent study in 2013 also said that we see as many as 80% stampede-related incidents happening at religious congregations, and despite that, the administration did not make adequate arrangements for this event.
Ruchi, thank you so much. Ruchi Bhatia, there, South Asia economy editor, getting us up to speed there on the tragedy, of course, that took place. Let's just very, very briefly have a look at where we are market-wise as we get into, of course, the next hour when markets over in India, of course, open up as well. A couple of things, right? AI stocks are moving. The World AI Conference and Summit is taking place in Shanghai, I believe, tomorrow. The Premier, Chinese Premier Li, is set to attend. Number one. Number two, as you look at Korean banks, day two of a rally there on the back of the Value Up program, and details there